So imagine you take out a mortgage on a house, right? But hidden deep in the contract is this clause that states if the local housing market dips for, like, even 5 minutes, an automated robot will instantly auction your home to a complete stranger.
Wow, yeah. Just gone.
Right. There's no phone call. There's no grace period. It is just instant eviction. And in decentralized finance, this nightmare scenario, it isn't actually considered a bug.
No, not at all. It's the foundational feature.
Exactly. It's keeping the entire stablecoin ecosystem alive. But what if you could just rip that foundation out entirely? Welcome to the deep dive.
Yeah, it's a massive paradigm shift.
It really is. So today our mission is to unpack this highly technical Ethereum research post. It was published literally today, June 1st, 2026, by Vibuterin. And we are looking at this radical new proposal for building synthetic index tracking assets.
Right, but doing it completely without relying on debt or forced liquidations or centralized issuers for that matter.
Exactly. It completely reimagines how risk is handled on-chain.
It really shifts the power dynamic away from those automated protocols and puts it directly back into the hands of you, the individual user.
Right, and to set the stage for you listening, let's actually establish what an index tracking asset actually is in this scenario. Because, I mean, imagine you want to hold an asset that mimics the US dollar, or say the consumer price index.
Yeah, the CPI. Or the source even mentions building an asset that tracks something as exotic as the average rent prices in a specific city.
Which is wild. But the catch here is that you only hold Ethereum, right? And you want to achieve this exact exposure in a fully trustless, decentralized way.
Right, because the main challenge is that you are operating in a closed ecosystem. The only genuinely native, trustless asset there is ETH. The system cannot just magically create US dollars out of thin air.
Right, it's a closed loop.
Exactly. So all of its internal assets and liabilities, they must ultimately balance out to zero in terms of ETH.
Yeah, and so whether you are an everyday crypto user looking for price stability to just, pay next month's rent, or maybe you're a developer trying to build the next generation of financial infrastructure, understanding this shift from a debt-based model to an options-based model, it is going to completely reframe how you think about digital risk.
It really is a fundamental rethink of the whole space.
Okay, let's unpack this, starting with the fatal flaw of the current system. Because why is that robotic mortgage scenario the standard today?
Well, traditional algorithmic stablecoins currently operate on this model of over-collateralized debt. And the source actually uses a very clear example to illustrate the mechanics here.
Okay, break that down for us.
So let's say ETH is currently trading at $2,500, and you want exposure to US dollars.
Right.
So you take one ETH, you lock it up as collateral in a smart contract, and the protocol allows you to mint or borrow 2,000 synthetic USD against it.
Okay, so I have one ETH locked in a vault somewhere and 2,000 synthetic dollars sitting in my wallet. I mean, I have a buffer of $500, so I feel perfectly safe.
Yeah, exactly. That buffer is your safety margin.
Okay.
But I mean, we all know that crypto markets are notoriously volatile.
Oh, totally.
So if the price of ETH suddenly drops from 2,500 down to 2,000, or realistically even like 2,100, because the protocol needs some breathing room, your debt is no longer considered safe.
Because the underlying collateral value is crashing.
Right. The protocol calculates that your collateral might soon be worth less than the synthetic dollars it actually issued to you.
So the structural integrity of the entire system is basically failing at that point.
Exactly. And to save the broader system from holding all this bad debt, the protocol initiates a forced liquidation.
The robot auction.
The robot auction, yeah. It publicly broadcasts that your position is underwater, and it allows any third-party actor to just step in, pay back your 2,000 synthetic dollars, and then walk away with your one ETH collateral at a massive discount.
Wow. Okay, so that brings us right back to the mortgage robot auctioning off the house.
Yeah.
But I do want to challenge the framing here for a second.
Sure, go ahead.
Because, I mean, traditional finance has margin calls, right? Brokers liquidate underfunded accounts literally all the time. So why is this sudden liquidation such a massive systemic vulnerability when we do it on-chain?
That is a great question, and it points us directly to the true villain of the current decentralized architecture. Real-time oracles. Because to execute a liquidation fairly, the smart contract requires this binding, authoritative data feed telling it the exact price of ETH at that specific millisecond.
Oh, right, because the protocol is completely blind without that external data.
Yes, it is entirely dependent on it. But piping real-time financial data onto a blockchain is incredibly unsafe. I mean, you are relying on a handful of automated actors to broadcast that signal instantly.
And if something goes wrong?
Well, if the data feed glitches, or if network congestion delays the signal, or even worse, if a malicious actor manipulates the spot price on a single exchange for just a few seconds,
Then the protocol triggers those massive cascading liquidations based on a totally false reality.
exactly. You are basically sacrificing long-term security for immediate speed.
Right. But what is the alternative then? Because if we know real-time data feeds are fragile, what is the actual secure way to get information onto a blockchain?
Well, the safest known method for establishing truth in any decentralized system is actually a prediction market.
A prediction market.
Okay. Instead of trusting a single data provider or a small committee, you allow independent actors to stake their own capital on what the true price is.
Right, but wait. Prediction markets are really slow by design, aren't they?
Very slow, yeah.
Because they require dispute periods. Like, if someone submits a malicious price, the network needs time to challenge it, vote on it, reach consensus. I mean, you might be waiting 3 days for a finalized price.
And that delay right there is the core friction. Because if the market is crashing, a debt-based stablecoin literally cannot afford to wait 3 days to find out the true price of its collateral.
Oh, wow. Because by the time the prediction market finally resolves, the collateral might be completely worthless.
Exactly, and the stablecoin collapses. So the entire debt-based ecosystem is essentially trapped in this paradox.
Right. It requires real-time oracles to function, but real-time oracles are fundamentally fragile.
Precisely.
Okay, so because the real-time oracles are fragile, the system needs to be able to rely on slow, secure oracles. But to survive a slow oracle, you have to completely eliminate the concept of sudden liquidations.
Yes.
Because a system waiting days for a price update just can't have a tripwire that fires in milliseconds.
Exactly. And to solve that paradox, the research post proposes basically throwing out the concept of debt entirely.
Okay, so no more borrowing.
No more borrowing. The new foundational building block of this system is synthetic options.
Synthetic options. Okay, let's walk through the mechanics of this because it requires totally abandoning the way we normally think about borrowing in DeFi.
It really does. So the source defines two distinct assets, which we will just call P and N.
P and N. Got it.
And these two assets are always created together as a pair.
Okay.
The parameters that define them are a ticker, so like the ETH to USD price, a strike price, and a maturity date that's set sometime in the future.
Right. So instead of putting your ETH in a vault and borrowing against it like a loan, you take one ETH and you physically split it into a P asset and an N asset.
Yes, exactly. And because they are minted together as a pair, you can just as easily combine one P and one N back together to redeem them for your original one ETH.
Okay, that makes sense. But where does the value actually come from?
Well, the magic happens when we finally reach that maturity date.
Right, the date set in the contract.
Yeah. So at maturity, the slow, highly secure prediction market finally resolves and delivers the official ETH price.
Okay.
Then the smart contract takes that final price and uses it to distribute the underlying one ETH between the holders of the P asset and the N asset.
Okay, so the original text relies on some pretty complex fractions to explain this distribution, but let's try to translate that into a visual for everyone listening.
Yeah, good idea. That helps.
Think of the underlying one ETH as a pie, right? At the maturity date, the smart contract basically uses the final price to decide exactly where to place the knife to cut that pie.
Right.
The P asset is mathematically guaranteed to get the exact slice of pie that represents the stable USD value you originally wanted.
Yeah.
And then the N asset, well, it just gets whatever slice of pie is left over.
Exactly. So if the price of ETH went up over that time period, the USD value requires a much smaller slice of the pie.
Because each slice is worth more dollars.
Right, meaning the N asset gets a much larger leftover slice. But if the price of ETH went down, the P asset requires a much larger slice to maintain its USD value.
Right, so the N asset shrinks. But no matter where the knife comes down, those two slices always add up to exactly one whole pie.
100%. Nobody can ever owe more than the system actually holds.
Oh, wow. Because P plus N mathematically equals 1 ETH in literally every possible scenario, meaning the protocol can never be under-collateralized.
Never. The system is never underwater.
So liquidation isn't just avoided through clever management here. Liquidation is literally mathematically impossible.
Yes, mathematically impossible. And what's fascinating here is that this specific mechanism, it actually has been stress tested in the real world for years now.
Really? Where?
It is known as a scalar prediction market. You see, traditional prediction markets are usually binary. They resolve to either a yes or a no, like a 1 or a 0.
Did this event happen, yes or no?
Exactly. But scalar markets, they resolve on a sliding scale between two bounds.
Oh, meaning this new proposal isn't relying on some untested, wild cryptographic experiment.
Not at all. It leverages highly proven infrastructure. Because these synthetic options are fundamentally just scalar prediction markets, they can share the exact same security mechanisms and dispute resolution networks that existing decentralized prediction platforms already use today.
So you're basically building on a foundation of solid bedrock rather than fragile real-time code?
Exactly.
Yeah.
The skyscraper no longer collapses when the wind blows.
Right. But, okay, from a practical standpoint, how does a user actually use this to simulate holding US dollars? I mean, if I split my ETH into this P and N pie, what am I actually holding in my wallet?
Right. So going back to our user scenario from earlier, ETH is currently at $2,500, and you want USD exposure.
Yeah.
Instead of taking on debt, you go to the open market and you purchase a specific P asset. And specifically, you buy a P asset with a strike price that is way below the current market price of ETH.
Okay, so the source uses the example of buying an asset called P1500. So the strike price is 1500, even though ETH is currently trading at 2500.
Exactly.
And in traditional finance, this is called buying a deep in the money option.
Yes, and that deep in the money status is actually what gives the asset its stability. But there is a really crucial catch to this entire architecture.
There's always a catch. What is it?
Buying that P asset does not flawlessly lock in an exact USD value over time.
Oh, because time itself is a variable here. Like, the maturity date might be 2 weeks away.
Precisely. Let's say a week passes, and the price of ETH unexpectedly plummets down to $1,600.
Oh, so it hasn't breached your 1500 strike price yet, but it is getting uncomfortably close.
Very close. And because of that risk, the USD-denominated market value of your P asset will actually begin to drop below its maximum face value. It starts to diverge from a perfect dollar peg.
Okay, and the text describes this divergence as happening quadratically.
Yes, quadratic drift.
Right, and just to demystify that term for you listening, quadratic basically just means the pain accelerates the closer you get to the edge. So if ETH drops $50, your stablecoin might lose a tiny fraction of a penny in expected value. You wouldn't even notice it.
Right, it's negligible.
But if ETH keeps dropping down toward your 1500 strike price, those losses start multiplying.
Exactly. It acts as a probability curve. The market is basically pricing in the very real danger that ETH might crash below 1500 before the maturity date actually arrives.
Because if it does, you don't get your full dollar value.
Right. So as you slide down that curve, the value just bleeds out faster and faster.
Okay, wait, I need to push back on this mechanic for a second.
Sure.
Because traditional finance has an entire Nobel Prize-winning formula designed to price this exact kind of probability over time, right?
You're talking about the Black-Scholes equation.
Exactly, the Black-Scholes equation. It factors in volatility, the time to maturity, the strike price. I mean, if we are operating on a smart contract that can execute complex math, why wouldn't the protocol just plug the Black-Scholes formula in to perfectly price that curve and magically maintain the peg?
So you are highlighting one of the most controversial fault lines in financial engineering right now.
Oh, really?
Yeah. The source explicitly warns against trying to hard code mathematical perfection into the protocol. I mean, post-2008, the Black-Scholes equation basically became synonymous with catastrophic fragility.
Why is that?
Because it assumes that markets behave normally and predictably, which is, rarely true in traditional finance and just completely false in crypto.
Right, the danger of trusting a mathematical model more than the underlying reality.
Exactly. And beyond the mathematical hubris of it all, there is actually a major mechanical roadblock here, too.
Okay, what is it?
To run Black-Scholes on-chain, the protocol mathematically needs to know the expected volatility of the asset.
Oh, I see where this is going.
Right. To know the expected volatility, the protocol would have to create another real-time oracle just to measure market skewness and kurtosis.
Oh, man, so we would be building a brand new, highly complex, real-time oracle just to fix the problems caused by our old real-time oracle.
Exactly. It defeats the entire purpose of the redesign.
That makes total sense. So instead of relying on a fragile formula, how does the user protect themselves?
The system relies on human behavior and active portfolio management. It basically uses a rotation strategy.
Okay, and the source actually outlines a very specific algorithm for the user to follow here. It suggests that if the current price of ETH is X, you should buy a P asset with a strike price of roughly half of X and a maturity date like 1 to 2 months out.
Yes. You buy deep in the money and you put plenty of time on the clock.
But the active part comes when the market moves against you, right? Like
Yeah.
if the price of ETH drops to 1.5 times your strike price, meaning it is starting to slide down that quadratic cliff we talked about, you don't just wait around for the oracle. You sell that P asset, rotate your capital into a brand new asset with a much lower strike price, and push the maturity date out another month.
Exactly. You never hold these assets to maturity.
Never.
Never. Because holding to maturity exposes you to the raw volatility of the ETH market while you just sit idle waiting for the slow oracle to resolve. You're constantly stepping off the asset before the curve gets too steep.
Okay, this shift completely rewires the psychology of the system.
It really does.
Because by removing automated protocol liquidations, the burden of action moves entirely from the smart contract to the individual.
Yeah.
In the old debt-based system, the protocol takes your house away against your will.
Yes.
But in this options-based system, the protocol does absolutely nothing. You, the user, must actively rebalance your own portfolio to protect your value.
Right. And placing that burden of action on the user provides two massive security upgrades for the broader ecosystem.
Let's hear them.
The first is a drastic reduction in MEV risks, or maximal extractable value.
All right, MEV, the hidden tax of decentralized finance, where trading bots monitor the network for forced liquidations and then front-run the transactions to extract profit from the victim.
Exactly. In a traditional liquidation, your destruction is this public, predictable event. The parameters are hard-coded into the smart contract. Bots know exactly what price will trigger the liquidation, and they just lie in wait.
But in this options system,
In this system, your decision to rotate your assets is a completely private choice. It just looks like a regular trade on a decentralized exchange.
so there is no forced protocol event for bots to front-run.
None at all.
That is brilliant.
And the second advantage is even more compelling, honestly, because it decentralizes the oracle entirely.
Right, the research post points out that a user doesn't actually need to rely on a blockchain data feed to know when to rotate.
Right. A user could simply run a local daemon-like, just a background Python script on their own laptop that pings a dozen traditional financial news sites.
So you program your local script to query Bloomberg, Reuters, Yahoo Finance, and maybe a few crypto exchanges.
Exactly. It pulls all those numbers in, throws out any obvious outliers, and just calculates the median price locally.
Because it's running locally on your own machine, nobody else on the network has any idea which sites you are checking.
Right.
There is no global, centralized honeypot for an attacker to manipulate.
Yeah.
You have completely decoupled the survival of your portfolio from any single point of failure.
Precisely. It is true decentralization.
Okay, so what does this all actually mean for the everyday user? Because the source does admit a pretty clear trade-off here.
It does, yes.
By relying on this continuous rotation strategy and constantly buying deep in the money options, your portfolio will experience what they call quadratic drift. You can basically expect to bleed about 1 to 4% of your value per year just through the mechanics of riding that curve.
Yeah, that's the estimated cost.
So I have to ask,
Mm-hmm.
doesn't losing up to 4% a year make this a pretty terrible design for a stablecoin?
Yeah.
I mean, if I hold a synthetic dollar, I expect it to remain a dollar.
Look, it is a completely valid critique, and the proposal fully acknowledges it. If your goal is strict tax accounting, where you need to prove to an auditor that your digital asset maps perfectly to a single US dollar down to the exact penny,
Right.
then this system is simply not designed for you. It is not an accounting stablecoin.
It's an approximation.
Exactly. But consider what stability actually looks like in practice out in the real world. I mean, fiat currencies like the dollar, the euro, and the yen, they regularly fluctuate more than 1 to 4% against each other on an annual basis anyway.
That is true.
And even highly respected algorithmic stablecoins in the current crypto ecosystem, like RAI, experience similar equilibrium drift.
Not to mention the purchasing power of a physical dollar bill drifts every year due to inflation anyway.
Exactly. So the goal of this architecture isn't to simulate a mathematically perfect fiat currency. The goal is to secure predictable purchasing power over time so you can confidently pay future expenses, while achieving absolute structural immunity against flash crashes and protocol liquidations. You are accepting a small, manageable amount of drift in exchange for never being force liquidated by a flawed real-time oracle.
That makes a lot of sense. So we've eliminated liquidations, we've bypassed fragile oracles, and we've secured the user against MEV bots.
Hmm.
But there is one final hurdle outlined in the text, and it's purely mechanical.
Right, the slippage problem.
Yes,
Yeah.
because if users are constantly running local scripts to rebalance their portfolios, they face the hidden killer of decentralized exchanges, which is slippage.
Yeah. And for those who might not know, slippage is simply the difference between the price you expect to get for a trade and the price at which the trade actually executes due to a lack of liquidity on the exchange.
Right. And the source warns that if a user is rotating their assets frequently, the cumulative cost of that slippage on automated market makers could easily eat up an additional 2% or more of their portfolio every single year.
Which is massive.
Yeah, combine that with the expected quadratic drifts we just talked about, and the entire system just becomes too expensive to use.
It really is the single largest systemic risk to the viability of the whole proposal. Because if the act of rebalancing is too costly, the system just collapses under its own friction.
But the text actually reveals a brilliantly elegant solution to this problem, and it isn't based on cryptography at all.
No, it's based on human psychology.
Exactly. The solution relies entirely on having a low time preference.
Yeah, and if we connect this to the bigger picture of market design, low time preference is just an incredible source of untapped capital efficiency.
How so?
Well, as a user trying to protect your long-term savings from a crash, you do not actually require instant sub-second execution on your rotation trades.
Right, you aren't a high-frequency day trader trying to scalp fractions of a penny.
Exactly. If your background script decides it's time to rotate your options, it really doesn't matter to your bottom line if that trade executes right this second or tomorrow morning or, even 3 days from now.
Because the crash hasn't happened yet. You're just moving away from the edge.
Yes. And because users can afford to be patient like that, developers don't have to build traditional automated market makers.
Which normally require immediate counterparties and those really steep pricing curves that cause all the high slippage.
Right. Instead, they can build entirely different market structures, things like one-sided market making or batch auctions.
Meaning you can basically just place a passive limit order and let someone else fill it over the course of a few days.
Exactly. And by allowing transactions to match slowly over time, you drastically increase the efficiency and almost entirely eliminate the cost of slippage.
Oh, wow.
Yeah. The perceived weakness of the system, its slowness, is actually weaponized into the exact mechanism that makes it economically viable.
That is incredible. It is just a masterclass in turning a bug into a feature. So to bring all of these concepts together, the core journey of this deep dive really demonstrates that by simply swapping out the concept of debt for synthetic options, we can solve nearly every systemic risk plaguing decentralized finance today.
It really is a sweeping solution.
We completely eliminate the nightmare of forced liquidations. We bypass the extreme fragility of real-time oracles by utilizing slow, battle-tested prediction markets.
Right.
And we hand the power of risk management directly back to you, the user, through local, private rebalancing scripts.
All for the totally manageable cost of a few percentage points of drift, which, as we saw, is mitigated by embracing low-time preference market designs. It is a fundamental rebuild of synthetic assets from the ground up.
It really is. Which leaves me with a final thought for you to mull over as we wrap up today.
Oh, I love these.
This paper essentially proves that forcing complex financial systems to operate in absolute real time is exactly what makes them so dangerously fragile. Speed is often the literal enemy of stability.
Very true.
So it's simply shifting our time preference, giving a digital system permission to be just a few days slow, can completely decentralize and secure global financial assets. What other high-stress, real-time digital systems in our everyday lives could be instantly fixed just by giving them permission to slow down?
That is a fascinating question to leave on.
Thanks for joining us on this deep dive into the Ethereum research archives. Keep questioning the foundations and keep exploring the edges of what's possible.